Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Sonal Bhutra, and it's a mildly lower start this Tuesday morning. The Nifty and the Sensex down close to about 0.2%, but the Nifty is holding on to that 24,300. And the single reason for the fall today is HDFC Bank. The heavyweight has a weightage of more than 11% on the Nifty. HDFC Bank right now is down 3.3%, and single-handedly it's taking away close to about 90 points on the Nifty. If it wasn't for that, we would have been in the green. The mid-cap index, though, is holding up with a marginal advantage.
It's very stock-specific today. We are tracking market levels, but that's not saying much because in the broader end, we are towards the fag end of the earnings season, so we are getting in commentary, we are getting in numbers. And Reema spoke about HDFC Bank, of course, that MSCI inclusion, it has gone the other way. The expectation was that it could lead to some green on HDFC Bank. Maybe markets would have been higher, but that is not something that has happened. In fact, it's a steeper fall today. A couple of names that I am looking at is from the chemical space, because Aarti Industries, after being unsure of their guidance, has led to the entire chemicals pack being under pressure today. So Aarti Industries, that one is down 15% now. That's a big cut on the stock. We'll of course discuss it in greater detail, but following suit is Navin Fluorine, you have Jubilant Ingrevia. These are the names from the chemicals industry where the commentary was decent, but now when Aarti says that maybe demand could be impacted, there's margin volatility, is something that has had the street very worried. Mid-caps doing well, 118 points higher there, and some of the earnings from the previous few days, they are seeing reactions even now. So something like an Inox win, strong commentary, strong numbers, 7% higher. You have something like a Gulf Oil reported strong numbers last week, but that continues its up move. So that stock is up 6%. You have other names, Aurobindo Pharma, for instance, is up 3%. So as I said, it's a very, very stock-specific market today, and that is something we'll be tracking closely.
Indeed, even RateGain, a stock which reported numbers yesterday, it was down, I think, 1.5%, 2% by the close of trade, a 20%, 21% top-line growth, but the stock today as well has seen a cut of close to about 2.5%. Sun TV continues to come under pressure this week, yesterday and today. It's lost a fair bit, 14% over the span of 2 days, so that's another stock. Ola Electric continues to shine in trade, 20% on Friday, 20% on Monday, and today it's up 9% and holding on tightly to all its gains. Inox Wind is another big mover. In a span of 2 days, this stock is up 28%. So that's another standout mover. In terms of the frontline action, we spoke about HDFC Bank, but outside of that, life insurance companies like HDFC Life, SBI Life have taken a bit of a hit. BPCL is down 2%. That's the second biggest Nifty loser after HDFC Bank. You've got cuts in Shriram Finance, 1.5% gone. On the way up, bit of a defensive tilt, you would say. Apollo Hospitals Britannia in the green with gains of more than 1%. Hero MotoCorp stands out with a 1.25%. And then you've got some of the private sector banks like IndusInd Bank, Axis Bank. They're managing to hold up in the green. And Bharti Airtel, where that mega deal took place, big outbound FDI by India with Bharti Enterprises, Sunil Bharti Mittal owned, Bharti Enterprises acquiring a near 25% stake in British Telecom. That's Britain's marquee telecom company. That stock is up today. But let's move on to Happiest Minds. That's the mid-cap IT company which reported numbers yesterday. Constant currency revenue growth of 11.4% on a quarter-on-quarter basis. Profits, though, have declined. But remember, there was an exceptional loss of 13 crore in the prior quarter. To talk about the company's Q1 numbers, we have with us the MD and CFO, Venkat Raman Narayan, along with that, the Executive Vice Chairman and the CEO of Product and Digital Engineering Services, Joseph Anantharaju, joining in. Gentlemen, thank you very much for joining in. This is Reema here. Venkat, first question, revenue growth of 11.4%. Can you tell us what the organic revenue growth was? Because the top line has been boosted by the 2 acquisitions that you've done.
We've covered our performance very well in those 3-4 sentences, but we don't call out our revenue growth organic and inorganic because it becomes quite complex. We have now 3-4 entities which have come through acquisitions and they track on their own. Quite a bit of effort that we put on our organic side growth heads towards those other organizations. So suffice to say, we talk only about consolidated growth. And we have put up a very good show, 17.8% growth year over year in constant currency, and similar growth of 11.4% quarter over quarter.
What about your full year guidance of 35 to 40% on revenues and EBITDA margins of 22 to 24%? Do you maintain it?
There is a small correction, if I should say. 35 to 40 was on the basis that I would get the full year impact on account of these two acquisitions of Pure Software and Aureus. But now that we have only got 40 days and 38 days respectively, we would be, that's now stands corrected to 30 to 35% is what we'll do for the current year, is what we are forecasting. I'm being a little careful with the use of the word guidance because, we are still coming to grips with the consolidated numbers as we speak. But 30 to 35 is a fair number for us to target for this year.
And what happens with margins?
Margins is 20 to 22%, which is, there is no change. I did say that when we were having the conference after the acquisitions, and we have reported 23.9%.
Okay. All right. Let me get in Joseph in the conversation as well. What is the demand environment like right now? You've seen negative growth in travel and manufacturing this quarter. You're talking about a 30 to 35% revenue growth this time. What will this be led by?
If you look at it, most of the verticals have grown on a quarter-on-quarter basis organically, and some of them have grown at a pretty good pace, upper single digits. The vertical I'd like to call out is EdTech, which had been flattish on an absolute term the last 2 quarters, but it's shown a growth of 6.6%. The manufacturing, which is where you see quite a bit of drop on a quarter-on-quarter basis, there are 2 reasons for that. The first reason actually is more of a restatement. 2 of the accounts that we had pretty decent sized accounts in the manufacturing vertical. They started with more of manufacturing, but their actual alignment, one of them is with high-tech, consumer electronics, and the other one is with industrial. So we did a restatement of both of those. The other reason being a couple of large engagements that we had in the with 2 large Indian-based auto manufacturers. They've come to an end, and there's a little bit of a gap before we finalize the requirements for the second phase. This is what has led to the drop. My sense is that next quarter, when we report Q2 earnings, this should have got regularized on a quarter-on-quarter basis. We should start seeing a growth. At a macro level, if you look at the demand environment, I think it continues. Customers continue to be cautious in how they spend, and the focus is more on short and medium-term initiatives that contribute to revenue growth or are able to optimize on costs. And therefore, our ability to quickly to identify these priorities and align with them has been very critical. And here, the verticalization that we did announced and which went into effect on 1st April has helped us out immensely, because delivery, sales, and domain have come together, and there's much more collaboration, knowledge sharing, and the joint sense of ownership of the customer, which has led us to align ourselves better, and that is reflected in some of the growth that Venkat talked about.
This BFSI growth, more than 60% on a quarter-on-quarter basis, is it purely on account of the acquisition, or even organically you are seeing growth come back in BFSI? And what is the outlook, Joseph?
So I think we did see some growth organically, but most of the growth has, as you rightly pointed out, Rima, has come through acquisition. Pure Software is focused. The largest vertical is banking and financial services, and Aureus is oriented more towards insurance. So between the 2 of them, they round out our BFSI story, and they've contributed to the huge jump that you see in the BFSI space. If you look at it across PureSoft, Aureus, and Happiest Minds, what we are seeing is that by and large, the spend is holding. A couple of customers have deferred their investments or their projects, second phase of their projects, into the next quarter. But I would say that it's much better than what it was last year, and we are seeing pockets of growth. And again, here, we have to again figure out what are the initiatives that are going to get funded, and quickly align ourselves to those initiatives. And that's going to be the key, I feel, for getting growth in the next 6 months.
So this project deferral is only in BFSI, or is it across other sectors too?
See, what we've seen is that it's very dependent on customers. I wouldn't actually
What for you?
put a sector.
No, for you, which customers have deferred their projects? You spoke about BFSI, but any, yeah.
And then in the manufacturing space, there's a break that I talked about. But that should come back, I think, by end of this quarter, and you will see that getting reflected in the next quarter's numbers. And with media entertainment, one of our larger customer had put a hold on some of their requirements, but they've started opening it up now. So we should see that coming into play in Q3 of our fiscal year.
Okay. Venkatraman, now that we are talking about an improvement in coming quarters, the deferrals also seeing a reversal. The average annual revenue per active customer is around $840,000. You've seen a growth of 5.5% on a sequential basis. When does it hit that $1 million mark? And is there any contribution that you saw from the generative AI business unit this time?
I think you're hitting all the right buttons. $840,000 per customer is absolutely a number that we want to talk about. Our $1 million customers has gone up from 48 to 58. Our average revenue, our customer revenue concentration has slightly trended down. And like Joseph talked about, we are now nicely splitting our, business amongst the domains of BFSI, healthcare, and edutech. So these are the strengths that we are seeing in the business coming out of both organic growth and also the acquisitions. Touching $1 million is that target, because somebody did ask me earlier, how many customers do you envisage when you touch the $1 billion mark? But my take would be that would be somewhere around 600 numbers, active number of customers, and with about 1.5 million per customer. So if you have that kind of a number and a metric to track on, that's a target that we have taken upon ourselves to reach by 2031. But right now those are back of the envelope calculations. Coming to generative AI, we have been one of the only very few companies who have actually started reporting it as a separate BU. This is what we have done. We have generated $855,000 of revenue this quarter, 20 POCs, customer connects contracts as we speak, with 55 conversations happening. 1.5% is the revenue that we are tracking on that BU. Now, when we look at the financials, there are things that get hidden. For example, the investment that we are making into this new BU, that's about $1.5 million. So my EBITDA of 23.9% or 24% that we are reporting is after the investment we have made into new BU, the investment we are making into the consolidation play of the earlier BU of PES and DBS, growing into new customers, and also we have hired a new sales head. Those investments will start hopefully paying dividends from the next quarter. So the numbers speak only so much, but fundamentally we are on a strong wicket right now with a little bit of a turnaround in the market that we are all expecting to happen in Q2, Q3. I think we should be on the upswing.
Okay, all right, gentlemen, thank you so much for joining us today and giving us those insights. So that's the word coming in from Happiest Minds, looking at a revenue growth of 30 to 35% and margins as they had guided for earlier. Time for a short break. Management of Kaveri Seed Company will join us next to discuss their Q1 numbers and the way forward. Stay tuned for that. Welcome back. Well, some pressure on Nifty right now. It's down 41 points. Of course, not a big cut, but it has come off from those highs. And Nifty Bank is the one which is down around 300 points. As we've been mentioning, it's courtesy HDFC Bank. A lot of movers in the markets. Balrampur Chini, for instance, we spoke to the management today. The company reported numbers during market hours yesterday. It was a good set, and today it's seeing gains of around 5% as we speak. Excite is the other one, which is at the day's high right now. So a lot of these names from the broader markets, which you should keep on your radar. We have IDFC First Bank, which is high right now, Bank of Baroda. So some of these banks doing well. So majority of this pressure is coming in from HDFC Bank as we speak. But as promised, let's get in the conversation with Kaveri Seed. It is in focus. The company reported a slight miss in its Q1 numbers. Revenue growth came in at 9% on a YY basis, but EBITDA margins contracted from 37.7% to 36.8%. The export business sales increased by over 400% in the year. C. Mithun Chand, the executive director of the company, is joining us now. Mithun, good morning. Thank you so much for joining us. Well, it's been a decent revenue growth, but margins have come in under pressure despite that growth. What has led to this, and what is the guidance for FY25 that you have in terms of revenue growth and margins?
Morning. This year was really very tough year, both in terms of the production, in terms of the sale, and in terms of the cropping pattern. If you see the mix of the entire sale, we were down in cotton by more than 25%. In spite we are down in cotton by more than 25%, we were able to pull out that 5% revenue growth this year, as we have done exceedingly well in both the crops like maize and rice. In maize, we have grown by more than 70% on a quarter-on-quarter basis, and in rice, close to 25% on a quarter-on-quarter basis. If you see as a standalone basis, our margins have marginally improved, including the EBITDA margins have marginally improved. But when you see as a consolidated basis, the margins looks like slightly down by 2 to 3% because as majority of the subsidiaries we sell cotton. This year, cotton, we had a very tough time in terms of the production. The production cost was up by more than 100 rupees a packet, and we were not able to realize much money from the market. So that's the reason you see a slight dip in the consolidated sale. But if you see as an overall picture, we have done exceedingly well when compared to the industry. All the cropping, if you see the cotton across India, it was down by more than 10%, and in the states where we were pretty strong, it was down by more than 20%. So that's a slight impact what we have done.
Just a follow-up on that, Q1 is usually your strongest year, right? And you're talking about some pressures that you've seen in Q1 itself. What does it do for the rest of the financial year? What are you targeting in terms of revenue growth, volume growth maybe in maize and cotton, and margins that you will work with?
Basically, majority of the quarters sale comes in the first quarter. First quarter is like more than 80% of the revenue, 70 to 80% of the revenue, and more than 90% comes in the first quarter. 90% of the profit comes in the first quarter. So 2, 3, 4 are lean quarters, but we are pretty confident that we'll do better than the last year. And second half, all the 3 quarters, basically the majority of the crop will be maize and rice. So we have better margins in that. So we think that we'll be able to maintain margins, and we can slightly show better growth than last year. As we see a good cropping pattern for maize, as we have seen witness good rainfall across India, and see a very good scope for maize crop in the coming quarters.
Okay, so your guidance is that margins should stay where they are, if not at least try and improve, right? That's the outlook for the remaining part of the year. What about your R&D cost? Because for the last couple of years, you've put in considerable effort to move away from cotton seed into maize, rice, and that's bearing fruit now. So what is the percentage of your R&D cost as a percentage of your overall sales? How has it moved? And going forward, how much do you anticipate spending on R&D?
As of now, if you take last year, the recurring expenditure was like 5 to 6%, and if you add capital expenditure, it was like 7 to 8% on the overall revenue. And I think if you see the first quarter itself, the R&D expense and the employee costs have basically moved up by more than 10%. So this year also we will be spending close to 6 to 7% of our total revenue on R&D. And as you rightly said, that we are already witnessing that, and it's a long time to get, it takes long time to get new products and hybrids, and whatever growth we have seen this quarter and in the previous quarters, it's all from the new products which are coming in. If you take 7, 8 years back, the majority of the portfolio, like 80% of our contribution was from cotton. Right now in the first quarter, it is already down by, it came down to 33% from 45% what it was last year, and if you see the overall year, it should be close to like 20, 22%. So even in these tough conditions, as we have a diversified portfolio wherein we deal with many crops, that's giving advantage for us. And going forward, we are working on mustard and bajra in the coming years, including vegetables. These all crops should do well in the coming years. And maize and rice, we see a very good acreages going forward as the demand is going up. So we see a good prospects, and we have got a very good pipeline hybrids down the line, which gives us confidence to have both volume and revenue growth. And if you see this year, as it was a very tough year, the production cost has gone up significantly when compared to previous year. And being a brand and by the performance of our hybrid, we were able to pass it on to the farmer. That's the reason we were able to maintain the margins. And I think we are the only company who has basically were able to maintain the margin this year.
All right. You are seeing good momentum in exports as well. Give us a sense of how much does it contribute to overall revenues right now? And that strong growth, will you be able to sustain it? Are you seeing higher freight costs? Is that a worry for exporters like yourself?
Last year, we have done 5 to 6%, like 60 crores of revenue from export. But if you see in the last 5, 7 years, 10 years, we are continuously working on it. We are adding new countries to it. This year also, we are adding new countries. We are very bullish on Southeast Asian countries this year, especially like Philippines, Indonesia, and Thailand, where we see a good initial trials of paddy. We have got very good results in paddy. So we are exporting to those countries, and even we are exporting maize to maize and sunflower to African countries. So in the coming years, we are even bullish on export market. It should definitely touch 10% of the revenue in the next coming 3 to 4 years.
When will it touch 10% exports? In how many years?
The next 3 to 4 years.
3 to 4 years is when exports as a percentage of revenues will be 10%. I know this is a tough one, Mithun, but is it possible to estimate what could be the volume degrowth maybe in cotton seeds? What is the anticipation of volume growth in maize and rice for the full year? Your own internal assessment?
Cotton majority of the season is already done. We are down by close to 25% in terms of the volumes. Whereas in maize, for the entire year, we'll be growing like 45 to 50% what we have grown this year, first year. And rice also in the same manner.
Okay. All right, Mithun. Yes, please go ahead. What were you saying?
First quarter gives a major indication of the entire sale, how it's going to be. And this contributes 80% of the total sale. And next in the coming quarters, maize is the main crop where we do the majority of the sale, and we see a very good demand for maize, and we will definitely grow than last year. So it should be like the growth than 50% in terms of the volumes in maize and 20% plus in terms of the rice.
All right, we get that. Thank you so much, Mithun, for joining us today and giving us all those details. That's the word coming in from Kaveri Seeds. We'll slip into a break now. When we return, we'll discuss market technicals with Mitesh Thakkar and also discuss the top trading bets. Welcome back. You're still tuned into Trading Hour, and at this point in time, there's a mild recovery. Nifty is down around 24 points. Of course, it's a very mild recovery that we are talking about. The mid caps, they continue to outperform. Let's talk about technicals of the markets. Mitesh Thakkar is joining us for a quick technical check on the market. Mitesh, good morning. Thank you so much for joining in. What are you making? It's not such a big dip that we are seeing, of course, but what are the important levels? Nifty stays above the 24,300 mark. Do you think that will be a support now? And what about individual names?
Good morning. So I think, there are two observations which are important. One is that when we fell from 25,000 plus to sub 24,000 levels, we've kind of retraced the 50% of the fall, and it's taken more days to retrace the fall than actually the fall which had happened earlier. So in that sense, it's not a very positive setup. But post that, it's still a rising channel, which is choppy, volatile, but not directional. So I think, the market is still contracting. 24,500 would be a very important mark. That's where the call open interest is, as well as the 50% retracement area comes in. And then 24,650, 700 zone. So till those are being captured, there's always a risk of the downside happening again or the retest of the earlier lows happening again. Now, for that to happen, the trigger would be a close, as you rightly said, below 24,300, 250 levels. I think once that breaks, then we might see a retest or maybe a fresh low being made. Till then, I think trade with stock-specific biases.
Okay, and when you say stock-specific bets, what would those bets be?
Yeah, so, I would have one buy and one sell. Havells is on the buying side. Yesterday we saw action in Voltas. Today Havells is coming up. So buy here with a stop at about 1808 for target of 1870. And Indus Tower, after a very good rally, is now showing first signs of profit booking. So sell with a stop at 420 for targets of 400.
Okay, thank you very much for that. We'll slip into a short break. We'll come back and tell you why Aarti Industries is down close to about 10-15%. IRFC Hudco also buzzing in trades. More details coming up when we return.
Welcome back. You're still tuned into Trading Hour, and a big move that we are seeing, a big stock of the day definitely is Aarti Industries. It's down 15% in trade right now. Now remember, this is one of the chemical companies which was first one to report a sequential recovery. But yesterday on the conference call, the management indicated that they're not sure whether they'll be able to achieve their EBITDA guidance that they'd given of 1450 crore rupees to 1700 crore rupees, because they're seeing a lot of margin volatility. There's a lot of pressure coming in from China as well. And that is something which is scaring the street right now. Yes, they talk about their volume guidance being at 20 to 30%, but they will finalize guidance only in next 1 to 2 quarters. That is when they'll see some clarity. In terms of demand, they say discretionary segments like dyes and pigments, they are seeing sequential recovery, but agrochemicals will see a recovery only in the second half of this year. But Red Sea crisis has impacted the global supply chain, and this is something which could impact volumes in some segments as well. The debt stands at 3,300 crore rupees, and it could go to levels of around 35 to 3,600 crore rupees. Now, this has come in as a surprise because no one was expecting a company which has been seeing sequential recovery and improvement in demand to say that they're not sure about recovery going forward. Again, it's a pricing pressure that they're talking about. Volumes, according to them, will continue to be higher. Now, brokerages like Morgan Stanley, they have an equal weight rating. They say an evolving product mix, because they're also focusing on energy applications, is driving higher margin volatility versus what they've seen in the past. MK says that while it was the 4th straight quarter of EBITDA improvement, they might not be able to achieve the guidance, and that is something which has come in as a surprise. They've cut FY25 and 26 EPS by 11 and 5%. Nuvama has gone ahead, they've raised the target price, but that's because of a rollover that they're doing to Q1 FY27. Agrochemical segment shall see a recovery from the second half. Kotak say that suspending the FY25 guidance is acknowledging that there is some pressure in the markets and there is some volatility as well. They retain their sell. Management continues to guide for 20 to 25% earnings CAGR for the next 5 years. But do remember, this is subject to multiple variables, including demand, competition, and commissioning timelines. So they are still not sure whether the company will be able to achieve the long-term guidance that they've given. And that's why this pressure. But a big fall, because this was one stock where positioning was also such where they will continue to recover.
And I believe in one of the reports, I think I read that Chinese dumping impacts about 70% of their product portfolio. It's that high?
It is because it is more commoditized in terms of their business, right? So that's why most of the commodity chemicals, they emerge from China, and that is where the pricing pressure is coming from.
Okay, and I think even that growth guidance of 20 to 30%, the management in the call said it appears to be challenging and it is aspirational, though they are still retaining that 20 to 30% growth guidance. Margin guidance, as Sonal pointed out, has been suspended. But let's move on and talk about HUDCO and IRFC reported Q1 numbers. Vamakshi joins in with the details. Vamakshi.
Well, absolutely. It's a good set coming in from HUDCO. When we look at the disbursements, they came in at 12,625 crores. This is an uptick of almost 19 times as compared to the same quarter last year. And this growth in disbursements is largely being led by their urban infra segment. Loan book came in at 1,03,815 odd crores. This is an uptick of almost 30%. And the growth in loan book has surpassed street expectations. So again, good for HUDCO there. But the NIMs have contracted to 3%. It has come in much lower as compared to a YOY as well as sequential basis, and has come in much lower as compared to what the guidance that the management had stated earlier. NII came in nearly 12% higher. PPOP saw an uptick of almost 16%, and net profit came in nearly 25% higher. Additionally, we also saw the asset quality for the company improve. GNPA improved by nearly 29 basis points sequentially, and NNPA saw an uptick of almost rather improvement of almost 3 basis points on a sequential basis. So overall, it looks like a good set for HUDCO, but IRFC also on our radar, and that is because the company reported a decent set. NII saw an uptick of 1.8%. PPOP came in nearly 1.8% higher. They also had a provision write back of nearly 3.6 crores as compared to provision that they had to create of nearly 50 lakhs on a sequential basis, and the net profit came in at 1,577 crore, an uptick of almost 2% here as well. So overall, a decent set for IRFC and a good set for HUDCO.
Okay, all right. Thank you so much, Vamakshi, for joining in with that. So those are some stocks on our radar. We'll do one thing. We'll slip into another break. When we come back, we'll discuss the market fundamentals with Deepak Shenoy from Capital Mind. Stay tuned for that conversation.
Welcome back. It's turning out to be a very quiet session, a session of consolidation. Frontline indices down a bit, hardly, but moving in a tight band. The Nifty is holding on to 24,300. It's all about individual stocks. Deepak Shenoy from Capital Mind is now with us to talk about the market fundamentals. Deepak, Capital Mind, your company has come up with an interesting analysis where you've analyzed the price action, the earnings action of small cap stocks, the indices, since COVID. Take us through your analysis.
So thanks, Seema. I think one of the things that we've been doing in Capital Mind is just trying to figure out the eternal question now is, are small caps overvalued because their P reaches 30 or ranges of that kind. One of the problems is that because the market has run up in the last year or the last couple of years, we feel that this this run up is extreme and there are lots of stocks that are way too expensive and so on. So to put that in context, you have to kind of take it in both ways. First, try to get an unbiased analysis. One of the ideas would be, is this P ratio of around 30 plus? And you can't take the NSE small cap 250. You have to actually take the BSE one because the NSE changed their earnings reporting format in 2022, I think, or 2020. But so you can't get a good P ratio kind of analysis of the past. But if you do that with the BSE 250, you find that today's ranges, while relatively a little bit higher than the average, are not meaningfully at an extreme. We've seen as much as 50 times and even 80 times plus in the past. So right now at 30 times earnings, it is not meaningfully high enough to say that it is way overvalued. The second one is that apart from the current year, the small cap earnings growth has actually been quite good. Past 5 years, if you look at it, they have actually grown their earnings 3x, and the small cap index is about 3.5 or 4x nearly. So in a sense that the market has actually gone up along with earnings. So in that sense, the overvaluation is not as extreme as you might think. So this part of the analysis, if you look at, provides a favorable picture. But there is an unfavorable picture as well, but because if you look at the past, and although P's have been higher, at any time when you buy the small caps, when their aggregate P is more than 30, the next 6-month returns tend to be negative for the most part. So that is the other side of this equation. So there may be pockets of temporary overvaluation, but I don't think it's meaningfully high, meaningfully negative for us in the longer term. I just feel that it's not as overvalued as one might think it is.
Oh, okay. So in that case, Deepak, what are you suggesting your clients when it comes to small caps? Because there's been a lot of caution, but we don't see that in mutual fund flows. They've ebbed, of course, from highs, but they are still steady on a monthly basis.
Yes, I think small cap indexes continue to be okay. It's not like, for instance, they've taken more of a hit this month than the Nifty has. But in general, we've seen that the earnings profile has not been, battered or been seriously negative. We've just seen earnings growth coming from like a 20-25% down to, I think, a little bit flat right now. So 1-year return right now on the small cap index is about 64%. But the the earnings growth itself is about flat or -3% or something like that. This might mean one thing. There are pockets of the market which are not growing, which are getting very high valuation. One of them, perhaps, to give you an example, there was a result today of IRFC. IRFC is valued at a very rich valuation, 37 times earnings, but earnings growth is relatively small because it lends to pretty much one customer. So at that point, you might wonder whether that is a company that on a fundamental basis may not be able to live up to expectations. But at the same time, you have companies like, and we own some of this, like say Keynes Semiconductors, where you had earnings growth of 50+%. Although it is valued very richly, they're actually showing reasonable amounts of earnings growth and a market that seems to provide more opportunities for future earnings growth as well in those contexts. So I think it's going to be stock specific in small caps. You got to pay for growth. You don't pay for no growth. And I think we made that mistake in FMCG, in MNC FMCG a few years back. We paid a lot of money, a lot of high P ratios, but their growth came up to be 10-15%. Look at what their prices have done in the last 3 or 4 years. Although we are in a bull market, they are lagging the market quite considerably. So we should be careful to not overpay for low growth. You can pay for growth, but you should definitely watch that growth is actually happening or not.
Deepak, what are the constituents of BSE 250? We know, like the index, the Nifty is over-indexed to financial. So for BSE 250, the data that you've analyzed, can you give us a sectoral color in terms of contribution? Because if someone just buys the index, they should know the exposure that they're getting into. Because everyone says that, well, there are very few, exposure to railways, manufacturing, defense can only be bought by these mid and small cap. So, tell us, how the individual segregate the BSE 250 for us in terms of sectors, in terms of exposure, and which pockets of those have done well in the last year in terms of earnings.
So the indexes change every 6 months anyways, because what happens every 6 months is the number of stocks, some of the small caps will become mid caps, some of the small caps will become micro caps. So there'll be a shift in this on a regular basis. So even therefore, the sectoral mix will kind of shift across. So I think if I will just look at, I don't think I have the numbers per se right now, but you've got a lot of companies in smaller end manufacturing, of course, some railways and some defense as well, which started off as small caps. Some of these were small caps and have become large caps, so like a Mazgaon dock at some point was in one of the small cap indexes, but it's now a larger cap stock. So this index thing would change. But right now, even here, there's about 20% of financials. Capital goods is about maybe 15%. I think healthcare is about 10%. And auto components are about 6%. These are the largest. There's some chemicals. And it's a very well represented series of stocks. So you actually have enough from real estate. For instance, Nifty has almost no real estate, but other than indirect exposure. So here you have direct real estate about 2.5%. You have media and entertainment, which does not almost, other than ZZ, which was in the Nifty a long back, you had no media player at all. So now you don't, other than the pockets of Reliance. There's a much bigger, like a 1.5% in the BSE small cap 250 in that. So it's more diversified as an index, but it's still relatively heavy on financials in the sense of 20% is financials versus Nifty, I think, is what 40 or 45% financials.
Very quickly, any stocks that you would like to draw attention to where the PE re-rating has been considerable, but earnings have not kept pace? You gave one example, but 2-3 others which come to your mind, or a few others?
Good question. I think right now, for instance, this quarter has been pretty bad for a lot of capital goods companies, simply because orders don't come in an election quarter. So you get very low visibility, you don't have much on hand and so on. But you can see some of the chemical companies have relatively low growth. Part of it is Chinese influence, part of it is the cycle itself. I think we've seen some of the steel players also have higher players. I'm not going to take a lot of names here because, they're not, I don't have the exact numbers in front of me. But the commodities players, at least in steel and steel tubes and so on, where the PE has been higher and growth has been slowing, those are the areas where you might find a little bit of extremes in valuation. There is a promise, for instance, in Inox Wind. The promise is there of potentially large future earnings. So in some of those cases, the current earnings may not necessarily determine what is there in the future. But I think a number of stocks over here, you'll find that, you'll have to map them. I don't have the exact numbers on, but I think commodities, chemicals, specifically, and perhaps in some small cap IT names as well, you do have lower growth and extremely high, earnings multiples that are being given. So I'd just be wary of that.
Okay, thank you very much for that. We will slip into a very short break. We'll come back and talk about Apollo Hospitals, Hero Motor Corp, and DOMS.
Welcome back. Well, the MSCI has announced changes as part of its August review, with changes set to be made on the 30th of August. Vivek Iyer is here to tell us more. Vivek.
Well, that's right. So, much anticipated event. The August index review is finally out. India is expected to see inflows of a little over $2.5 billion, which means that India now has the second highest weightage in the EM basket of close to 19.8%, second only to China. So these changes, will be made on August 30th, and the MSCI Global Standard Index, the index that we track on account of the higher impact that the changes over here actually sees, will see 7 additions and 1 deletion. The MSCI Small Cap Index will see 27 additions and 6 deletions. Now, when you're talking about the MSCI Standard Index, which are the top additions, Zydus Life, over $218 million of inflows. The other names include Prestige Estates, Dixon Tech, OFSS, Oil India, Vodafone Idea, as well as RVNL. On the other hand, there is one deletion. On the account of underperformance, Bandhan Bank actually exits the MSCI Global Standard Index, and it will see outflows of close to $109 million. The other important development that the street was anticipating very closely was the inclusion or the weight increase of HDFC Bank within the MSCI Standard Index. Along expected lines, MSCI has increased the weightage of HDFC Bank after the company uploaded its shareholding pattern, which indicated that the foreign room there was quite high. Now, what's actually happened is that MSCI has decided to increase the weight of HDFC Bank in 2 separate tranches. Earlier, the street was anticipating that this could be done in one single tranche itself. So in this particular tranche, IIFL estimates close to $1.4 billion of inflows into HDFC Bank, and this will happen at the end of the month. Also remember, MSCI has lifted the embargo on Adani Group stocks, indicating that now Adani Group stocks will be treated like the rest of the pack when it comes within the MSCI basket.
Thank you very much for that. Zydus Life, despite that weight increase, is under quite a bit of pressure, down 5% today, down close to about 9% over the last 2 days. And here the problem is on earnings and valuation. Remember, post-earnings, CLSA downgraded the stock, citing concerns on long-term growth sustainability plus rich valuations at 30 times FY27 PE. So Zydus Life, despite the good news on the technical front, MSCI weight up, the stock continues to come under pressure. Let's talk about Hero MotoCorp reports Q1 numbers. Sudarshan joins in with the expectations. Sudarshan.
Yeah, so two-wheeler major Hero MotoCorp will be reporting its Q1 earnings today, and these earnings are expected to be strong with all the headline numbers are seen at multi-year highs. But before talking about the numbers, let's look at some of the internals. It's the cheapest stock amongst two-wheelers, and 1 year forward P is 22 times and is slightly higher than 5-year average of 18 times. And in 2024, so far, the stock has been up 28% and it's 10% away from the record high that it hit in June. Now talking about the numbers, net profit is seen rising 28% to more than rupees 1200 crore. Revenue is seen increasing 21%. EBITDA is seen rising 31%. And margin too may rise 100 bips to almost 15% against 13.8% in the same quarter last year. So what all will aid the numbers? As per brokerages, first, healthy volumes. Q1 volumes are seen rising 14% year-on-year to more than 15 lakh units, led by rural recovery and the new launches. Second, rich product mix and rise in average selling price. Average selling price has increased 6 to 7% and product mix has recently improved, and that is likely to aid the margin. But there are few concerns as well. First, company has been losing market share in its stronghold 100 to 110cc segments. Second, despite several launches, market share has been low in premium segment. And last, Honda has dethroned Hero from the #1 position in its overall dispatches in the Q1. But it seems any impact from these concerns might be offset by positives, as company is expected to report a very strong set of numbers for April to June quarter.
Okay, all right. So expecting good numbers from Hero MotoCorp. Thank you so much, Sudarshan, for joining in with all those details. Well, similar expectation is from Apollo Hospitals as well in Q1. It's expected to be a good quarter led by their hospitals business. So if we take a look at the overall numbers, revenue growth is expected at 15%. The EBITDA is expected to increase by 33% on a YY basis, leading to a margin expansion of almost 200 basis points and profits to come in at 274 crore rupees. That's the number that we're expecting from Apollo Hospitals this time. The 15% revenue growth, it will come in on the back of 7 to 8% rise in average revenue per occupied bed. And the improvement in margins will also come in because of the hospital segment. The hospital segment, in terms of the top line growth, the street is expecting a number of anywhere between 12 to 14%, and margins here could improve by 10 to 12 basis points on a YY basis. If we talk about the Apollo Healthco company, that's where these sales are expected to grow by 15% plus, and it is to be driven by pharmacy distribution sales plus traction that the company has been seeing in 24/7. For 24/7, costs are likely to be flattish on a quarter-on-quarter basis, but it will be lower on a YY basis, explains the margin improvement. And the GMC is expected to grow by 6% on a sequential basis. The EBITDA is estimated to be marginally positive for the Healthco company this time, expected between 20 to 25 crore rupees. So it will be an all-round improvement for Apollo Hospitals, maybe ahead of those expectations. The stock is higher by 2% as well.
That's Apollo Hospitals for you. The mid-cap index, the screen is very, very vibrant. You've got First Cry, that's up now 50%. You've got strength in Federal Bank, 2.5% gain. Triveni Turbines came out with numbers a couple of days back, but the stock is seeing some buying today, 8% up. You've got Oil India, NTPC in the PSU basket, which is also trading with considerable strength. Well, with that, it's curtains down on Trading Hour from the entire team. Thank you for watching. Stay tuned. Halftime report is up next.